Hey, what's going on, everybody? My name is Fernando Corona, and myself, along with my wife and our almost 18-month-old daughter, have been investing in real estate, honestly, since my daughter was, before she was born. She was in the oven. Anyways. Sorry. Hey, what's going on, everybody? My name is Fernando Corona, and if you're new to my channel, my wife and I have been investing in real estate for the past 3 years, along with our daughter, 18-month-old daughter, and she has been learning along with us. So today we're going to be talking about how I've been using an LLC, taxed as an S-Corp, and a C-corporation to protect my assets and limit my tax liability. I can't say that this is going to work for everybody, but I wish somebody had explained it to me as hopefully simple as I'm going to break it down for you guys. So at least you have this information to compare against all the other information that's out there. And I'm not saying that this is the only way that you can limit your taxes and protect yourself from liability, but this is the way from all the research that I've done that resonated with me, and I'm kind of going through with it for right now. Just as a disclaimer, I'm not a tax expert, I'm not a tax strategist, I'm not a lawyer, I'm not a legal entity strategist. This is something I have a team who has coached me through all of this, and I'm just sharing in hopefully layman's terms with you guys what I've learned. I got my iPad here, so we can kind of dig into it. Let's go. Okay, so we're going to go over kind of the structure that I have laid out. So I'm in California, and here I have an LLC, and this one is taxed as an S-Corp. And the reason why is because if this is my consulting company, and if I make a lot of money in my consulting company, then all that would typically flow through to my personal taxes if I did not tax it as an S-Corp, which means I'm paying 15% more on self-employment tax. Self-employment tax, for people who don't know what that is, because I didn't know what it was, it includes like Medicare, Social Security, maybe disability in there as well. So that self-employment tax is like 15%. If you're a business owner and you're not taxed as an S-Corp, then you're paying that 15%. Caveat to that: if you're not making $50,000 or $40,000 in profit, then you may not even consider that. If you're making $40,000 in profit or more, then go talk to somebody and ask them that question. Hey, should I be an LLC taxed as an S-Corp? If you're making like $40,000 gross income, you could probably write off enough stuff to bring that whole entire profit down to 10 grand or less. So then you may not even have to worry about the S corporation, because it's not worth it to go through the hassle of paying somebody and all that stuff. It may just cost you more than if you're making actually $40,000-$50,000 or more in profit after all your expenses. At that point, you want to be an S corporation, taxed as an S corporation, to bring down your tax liability. All right, so that's what we're doing here for our LLC, taxed as an S corp. Next up, we've got some companies in Wyoming, and I have a holding company there. And my holding company is there, and it holds a lot of my other businesses. So think about like Coca-Cola. Coca-Cola is like a big company, and underneath Coca-Cola, you have all these like subsidiary companies, and then they might flow up to Coca-Cola. So underneath a holding company, I've got LLC 1, I've got LLC 2, and so on and so forth. LLC 3, 4, 5, 6, 7. Underneath LLC 1, I have a house. Underneath LLC 2, I have a house, right? So on and so forth. Then I even have one LLC that is sole job is to raise capital. So one LLC raises capital for me, and then with that money, I can flow it into other LLCs and stuff like that. So the reason why we structure it this way is any of the profit, like each of these LLCs will take their own deductions, and when they take their deductions, if let's say LLC 1 has a significant gain and LLC 2 has a loss, when it flows into my holding company, that profit and loss kind of offsets. And then for my holding company, which is cool. So right away, that's the benefit. That's a benefit. If somebody goes and sues one of my LLCs, like let's say LLC number one, then they don't know that I own 20 other LLCs, or even if they did, they wouldn't know how to find them. They don't know, because they don't have access to my operating agreement. They don't know who my holding company is. Okay, so what I'm sharing with you guys is a structure, but when they go and they look up this LLC, they may not even be able to see that I actually own the LLC. That's how it protects me. Somebody goes to the LLC, says, who owns this property? Well, who owns that property? It's this LLC. It's like, okay, well, they go to that LLC and they look up, okay, what other properties does that LLC own? They won't be able to see any of the properties that LLC owns. And they, like I said, they may not even be able to see that the owner of that LLC. Now, even if they could see the owner of that LLC, or if they see people who signed for it, it just makes it a little bit more difficult. That doesn't mean that they can access more assets, right? Because the LLC doesn't own more assets. So that's how we structure it. Now, the way that it works from the holding company to my consulting company, because the holding company, it's just an LLC. So let's say the holding company has a profit of $50,000. I'm just making these numbers up. Maybe let's say 20,000, after all these expenses and depreciation, all that stuff, maybe it still has a profit. And I'm going to share some more things with my C corporation and how it takes some of the profit away. But let's just say there's a $20,000 profit. Now that would, that has to typically flow straight to me. And if it flows straight to me, then that goes to as a personal, that's like a personal that I get taxed on, and I have to pay self-employment tax on all that stuff with it. So we can structure it where we limit the income in the holding company, and just seeing if we need to pay my consulting company for consulting, across all of these LLCs. So we can look to move some of that income into the consulting company where it's an S corporation. So reduces my tax liability. Okay, that's one way. At the end of the day, we want to reduce the amount of money that's inside of this holding company. And so one way is to move it into the consulting side as of income, right? It's legit. I'm a consultant. So if I consult people every day on their real estate investing, so I could, be a consultant for a partnership holding company or partnership LLCs, because not every LLC I am the flat out owner, right? I am partial owner in that LLC, but I could also still be consulting for that LLC. And now we go into the C corporation. So here's the C Corp, and it is also a Wyoming company. And you're going to get different takes on this. I'm not here to try to completely argue for a C corporation. I'm just, like I said, sharing what's worked for us and what we're doing. But some of the arguments you get is this is for big companies. You'll get that it's a lot of paperwork. You get that double taxation is a big one that you get here. So it's not only for big companies. There's a lot of deductions, a lot of benefits for C corporations. You can operate at a loss an infinite amount of years, and you get a lot more deductions than an S corporation or an LLC would. You can reimburse, people, and a C corporation can be a management company to your other businesses. The paperwork, there's paperwork involved, so there's more admin. But if you have a team, if you're looking to scale, and again, this is all for your protection, to protect your assets and to protect your taxable income, then it's worth doing the work, or at least hiring a virtual assistant or a team member to do that work for you. So I have a VA, and with all the paperwork that needs to be done, I'm training my VA on what paperwork to do and then how to store it. So this is it's part of the work, right? You're either going to pay for it in taxes or all these other stuff, or you just do some of the work and delegate it out. And then you got the double taxation thing, which would be true if I took a salary or I was paid out as a shareholder from the C corporation. But if I don't take a salary and I don't get paid out, then only the C corporation will pay taxes. And the tax on a C corporation is 21%, which is lower than, the personal income, depending on where you are in the tax bracket. So just be aware of that the double taxation doesn't apply if you don't pull money from the C corporation. For me, I have my S corporation. That's where I pull money from. And my C corporation can always reimburse me if I am spending on certain things, then they'll just reimburse me. There's ways to navigate that realm. So that's how they're interconnected. Actually, the way that they're interconnected, the way the C corporation, how this comes into play, is this C corporation is classified as a management company, and as a management company, they manage my LLCs. All these LLCs, they manage all those. And a management company is a legitimate company. People do this all the time. I have a friend who he has a coaching program and he launched it, but he doesn't want to manage writing the emails, building out the sales team, building out the marketing, building out the ads and all that. He doesn't want to manage any of that stuff, any of the contracts. He just wants to be the entrepreneur who attracts leads, closes deals, teaches people. So he hired out a management company. I think he pays let's say 40%. Pays them 40% of all revenue. And then, so that's how the management company is able to obviously keep up with all this stuff. And that's, I don't know if that's 40% of gross. It is. It's 40% of gross income. And that's the same situation that I'm doing, except I own my own C corporation. So what does that mean? That means that I actually have a contract. It's a management agreement. Just type it in Google, simple management agreement, where and it basically says that 25% of, this is percentage of gross income from LLC goes to management company. So let's say across all my LLCs, I make 50K. No, it's not even say that. No, it's really more. Let's say it's 100K because we're talking about gross income. So let's just say it's 100K because remember it's gross. Gross means before expenses. And right away, 25%, I can deduct 25,000 just like that. Deduct it. That's one expense that I can deduct from my LLCs. And so now I only have 75K left here. And this 25K goes to the C corporation. Remember, the C corporation can take its own deductions. So it's possible that 25K over here, that's 25K of income. But since it can take its own deductions, we don't have to get into what all these deductions are right now. But just think about it in terms of now it can take its own deductions. So maybe this cancels out to zero. And over here, I got 75K. I leverage tax depreciation on the properties, whatever. There's all these deductions you could take. And so the goal is you reduce that one as well. Let's say I got, 60K in depreciation and deductions from the properties. Now this holding company might show only $15,000 of income. And then that goes into my personal income, right? So that's what I would be taxed on. So in this example, this is how we're using my consulting company, how it gets my consulting income, pays my S corporation, right? My LLC taxes an S corporation. My S corporation has to set me up as a salary. So I'm a salaried W-2 worker for my own S corporation. And then from there, I have my holding company in Wyoming that owns all these different LLCs across the nation. And then that holding company, any of the profits the gross income from any of the LLCs that I have under that holding company goes to my management company in my C-Corp. And C-Corp can take its own deductions. Each LLC can take more deductions. The holding company can take more deductions. And then the consulting company takes the deductions. And at the end of the day, when I have that S corporation, I don't have to pay self-employment tax. This is the current strategy I have to protect my assets and then also limit my taxable income. If you have any questions, comment down below. If you want to have a battle as to why I have this structure, don't comment below. I'm not here to try to fully defend this because I don't know everything that's out there. And this is just what's worked for me. And I'm just sharing it in hopes that somebody watches this and just says, you know what, this kind of helped clarify a little bit. from what you guys have been learning. And if it has, awesome. Let me know in the comments. Appreciate it. If you liked this video so far, you like what I've been sharing, and if you want to see an actual breakdown of my numbers, like real numbers, like, subscribe, share this video. If I get enough comments and I get enough likes, then I will do this whole breakdown using real numbers, using my actual tax returns, using my actual profit and loss statements and gross income. So you could see with this, how much income did I bring in and how much taxes did I pay? All right, guys, catch you later.